Hi, this is John Holohan, and I'll be presenting the Arlington Wealth Management Proactive Investment Strategy Update. Well, in today's update, you're going to continue to hear about the cautious approach we have with markets right now. While the proactive model is on a buy signal, the economic model is telling us there's the potential for a recession down the road. In the last report, Joe voiced concerns about market breadth and the number of stocks participating in the current market trend, that it's been fading. We got that 210-day warning signal earlier in October and took action based on that. And since our last report, we've also seen the universe trend indicator, which is another long-term breadth indicator. We've seen that shift from neutral to negative. With the recent 210-day warning signal, we raised significant cash and cash equivalents as a defensive measure, as a risk management measure. We're watching closely to see if this market is setting up for a tactical buying opportunity, or if perhaps the market is primed to have another leg down coming off of the high of early 2022. So for now, risk management and capital preservation are the theme, and we can patiently wait for the right opportunity to shift to more of a capital accumulation mode. So let's check in on the dashboard. So you can see the market model, the proactive model, remains on a buy signal, and that started late last year. The core indicators are a mixed bag. The cash comparison has been flipping between negative and neutral for a number of weeks now. The long-term momentum remains positive. We won't get another reading on that till month end. And we've seen the universe trend indicator, as I mentioned, shifted from neutral to negative. So let's start our review there and check in on the universe trend indicator. So here's our two versions of the universe trend indicator, which we use in combination to score the overall signaling for the universe trend indicator. And on this chart on the left side, we measure the percentage of stocks on their logarithmic point and figure charts that are on positive trends. And here, the percentage of stocks in the universe on their traditional point and figure charts that are on positive trends. So what we presented in the report 2 weeks ago was this chart had already been in a descending column of O's, so it had already reversed down coming off of that July high in this measurement. So we saw a shift of a significant number of stocks from positive trends to negative trends. And that was in effect, if you will, confirmed by this shift down since our last report. Again, hit a high there with that 7 in July, reversed down, and that's a 3-box reversal. So that's a shift of 8% of stocks in the universe have shifted from positive trends to negative trends since that July entry. This is a breadth indicator, and it's a longer-term breadth indicator. So when we look at things from a long-term perspective, and that's why this is one of the core indicators and not a tactical indicator, this gives us concern in the long run for the overall market trend. And while it's not used in our actual signaling for the global buy signals and the global sell signals, we do consider this a very important piece of information in the puzzle. Now back at the dashboard, shifting to our tactical indicators, we see that both of them are still at a low risk level. The 10-week is at 26%, and the overbought oversold indicator is in an oversold status. Let's take a look first at the 10-week chart. Just to get our bearings, this is another universe chart. So it is measuring that from that same universe, the percentage of stocks that are currently priced above their 10-week average price. So increasing levels here means a stronger market, more stocks moving up and dragging that 10-week moving average up. Descending periods mean the opposite. It means some of those stocks are slipping below their 10-week average price. So if we look at recent activity, and Joe discussed this in the last report about how we came off of high risk here over the summer and have dropped down and hit a low risk level that to this point has reached that 18%. So that's a pretty low number of stocks that are priced above their 10-week average price. We have seen a rebound in the indicator, but now we've seen a reversal down. So we're, observing here to see if this was, a little bit of a head fake here, and now the market is going to fade and begin to retest the market lows, or if this is just a little bit of reaction to some of the pretty significant news items and perhaps that low is in. But it would not surprise us at all to see a retest and perhaps even another low in this indicator. In any event, it being a short-term indicator, it tells us we have seen some risk come out of the market. I mean, certainly that pullback has put prices at a significantly lower level. This is one of the indicators we watch to help us understand if a tactical buying opportunity is going to be presented, but it's certainly too early to tell at this point. Now, shifting to our second tactical indicator, this is the overbought, oversold chart. And just to get our bearings here, the black line is the MSCI All Country World Index, daily close for 3 years. The blue line, we calculate that in our software. We call that the bull trend average. In the case of a bullish cycle like we're in now, we call it the bear trend average when we're in a bearish cycle, as we see in the 2 periods here that happened last year. We also impose the red lines, which represent high risk. In other words, when stock prices are extended in the short run, they can bounce up against that red line. That can often be some resistance for stocks. Think of a rubber band. When it expands too far one way, you see the tendency for it to pull back, snap back, and go the other way. Here, green lines designate oversold, and similar case where stocks have extended to a bit of an extreme as determined by our proprietary strategy, and perhaps are set up for a bounce the other way. There's certainly no guarantee for that, though. We certainly could see this momentum to the downside continue and reach beyond that low risk oversold level, perhaps to the extremely oversold level, or even more. I showed a 3-year picture here today because I wanted to just kind of give us that perspective. Last year, 2022, was obviously a lot of turbulence in the market. Depending on the index, markets peaked either in late 2021 or early or very early 2022. And then you see a decline that began in earnest early in the year and kind of played out at least to an interim bottom to this point in the October timeframe of last year. Most of the major indices kind of have this very same shape. Everyone's going to be a little bit different and notable. So after we shifted to the global buy signal here, the market got a decent head of steam, but now shortly after we hit the overbought levels here, the market's kind of had a pretty quick pullback here. Now, when we couple that with our concerns about the market breadth that we see kind of stumbling, if you will, where we see fewer stocks participating in the uptrend, and in a little bit, we will look at that 210-day warning indicator, which was discussed in the report last time. And it does give us concerns on how things may play out from here. Just want to point out a couple of things. Since those market highs in the major indices back here in late 2021, early 2022, you see that stock prices are a decent amount off of those highs in the market. It sure looked like the market was going to try to rally here and maybe challenge those levels. But where we sit today, the major indices, ballpark, the S&P 500 is about roughly 11% off of its high back here in early 2022. The All Country World Index itself, the one we track, is down probably about 15% since its high. And then just to throw in one other popular index, the NASDAQ is down about 16% from its high. So still a ways to go for markets to really reestablish a positive trend in a meaningful way. And so in the previous report, Joe talked about how, we saw this downtrend, we've seen a rebound attempt, and now we're really observing to see, is this some type of a consolidation of this move? Or is this potentially another leg down? And this is, let's call it a longer bear trend rather than a shift to a bullish trend. So we'll keep an eye on things very closely for this. At low levels, if this turns out to be just a consolidation. These could be attractive levels to deploy cash at, and we have built up cash. I'll talk about that a little bit later. But we're going to need to see some improvements in things before that tactical buying opportunity would be identified by our strategies. So next, I'll update you on the status of our 210-day indicator, the one that actually gave us the warning a couple of weeks ago or so and caused us to get a little more defensive and put additional risk management changes in place. Our goal during turbulent times such as this is capital preservation and patiently wait for what we would view as a good entry point, a good buying opportunity to shift to more of a wealth accumulation mode. So this is another breadth indicator, another indicator based on a universe of stocks, that very same almost 4,000 stock universe. And so what we saw that triggered the signal was a drop below 50% here in that percentage of stocks with rising 210-day average prices. Now, since then, we actually have seen a 3-box reversal up, but we're really waiting to see some follow through there because stocks have hit the skids here in recent days. And while there's not enough degradation to reverse this down, it's certainly enough for us to keep a close eye on. So a sign of a healthy market would be for this indicator to, kind of stabilize somewhere in this area and begin to move back up. But the other scenario, of course, is that, potentially there's a continuation of that bear market from 2022, and so we would establish new lows in this indicator. Time will tell, but again, this is a very important indicator for us in terms of that shifting to capital preservation mode that we're in right now. And now just to give a little bit more background about this indicator, because I know sometimes it's difficult to visualize, what a universe is and what is actually behind this indicator because we consider it to be so important. So let me shift to the chart of an individual stock just to give you a sense of how this measurement takes place. So here's the chart for Goldman Sachs, which is one of the constituents of that universe that we discussed, a little bit less than 4,000 stocks. And what I put on here, this is a daily close for 3 years. I put on a 210-day moving average. So it's the average price over the previous 210 days. So you can see the stock was on a very healthy uptrend back here, coming off of COVID, kind of hit the skids late 2021, like many stocks did. Looks like it was trying to put in a bottom here. But you see that during this period here where the stock stumbled, this shifted from a positively sloped moving average to a negatively sloped moving average. So during this period here, you would have this count as a rising 210-day moving average. And so it would be counted in that percentage. Here it slipped, and so it's no longer counted in that percentage, it's dropped. So the percentage, comes down a little bit because of this one stock. So let's fast forward a little bit here, and as we come through 2023, you see the stock kind of mostly sideways. It moved up enough for this to become positively sloped and, tried to get going. And, now it's pretty clear that it's a negatively sloped line. And this is the concept of, potentially a stock rolling over from a positive trend to a negative trend. So at this point, again, this is a contributor to a drop in the 210-day rising indicator, which is our 210-day warning signal. So imagine this very same chart for nearly 4,000 stocks, and you add up the number that have positively sloped 210-day moving averages, and then you're able to calculate the ultimate reading that we present, which is the percentage of stocks with rising 210-day moving averages. I wanted to follow up to one slide that Joe presented in the last report, and that was the U.S. housing starts. He showed a chart with the 1-year moving average of housing starts in the U.S. as well as a 2.5-year moving average of U.S. housing starts, and both of them were beginning to decline. And that's, one of those things that could be a warning sign of a potential recession. It is one of those sub-indicators in our economic model that is a decently strong correlation with predicting a potential recession. And it's somewhat troubling to see that begin to roll over. Now, I do this as a follow-up point to that chart from a couple of weeks ago, which is, perhaps what's behind some of that housing decline. And here you have the 30-year mortgage rate charted over 10 years. And we see going back 10 years ago through probably most of 2019, certainly before we dip into the COVID action here, you would see rates between 3 and 5%, kind of on average. And then COVID hit, of course, and all of that turmoil and increase in money supply, etc., drove down rates. And now what we've seen, kind of starting in early 2022, rates moving up from 3% quickly to 5%, and now accelerating pretty strongly above 5%, with a still a pretty strong upward trajectory. Last week reading was 7.63% for a mortgage. So that's a pretty steep hurdle for many home buyers. And so that could be a very strong explanation for the stumbling of new housing starts. So certainly if we see this increase continue, we might see the decline in housing starts accelerate to the downside, which could be even a stronger predictor for potential recession. Here's a chart that I check in periodically on. This is U.S. total assets held by all Federal Reserve banks. So you could call this the Fed balance sheet. In other words, how many assets have they brought onto their books? And I've got a 10-year view here. I'm presenting this as just a little bit to show what's happened and maybe a little bit of an explanation from my point of view of what could have contributed to some of the volatility last year and this year. So just a little bit of history here. We'll retrace coming off of the housing bubble in 2008, 2009, and all that volatility. The Fed was actively buying assets, then kind of leveled off here through 2015, 16, and then they committed to the so-called taper, which is tapering the balance sheet, and thus they begin to have a net decrease in assets held by the Fed. And, if you remember, think of this as, money being removed from the system, if you will. Fed no longer buying assets, but being a net seller of assets. And, if you recall, 2018 was a pretty volatile year. That tapering continued into 2019 and then began to rise a little bit before 2020. And then, boy, look at the knee of the curve right there with COVID, where the Fed to support markets, just went in force to buy assets, put them on the books. And now we see things continued through the start of 2022. But then now we begin to see again, and they had talked about it, beginning to taper the balance sheet, be a net seller of assets rather than a net buyer. And decent correlation in terms of the market peak and the beginning of some of that turmoil in markets last year. And you see, with this one exception here, this little blip continues somewhat in earnest. Now, could this explain some of the market volatility that we've seen in recent months here? I would think it could at least partially explain it. And I generally tend to think of this measurement as, being supportive of stock and bond markets, when it's increasing, and then being headwinds for bond and stock markets when this is decreasing, in general, I should say. So to wrap things up, we continue with our cautionary tone, being more of a risk management and capital preservation focus in models right now, with the concern about the lack of long-term breadth in the market. In other words, without a good number of stocks participating in a rally and the number of stocks that have failed to recover positive trends after the correction in stocks in recent months, it's concerning enough to us to think that the longer-term trend is questionable enough that we're going to be very cautious right now. We can patiently wait for a better capital accumulation opportunity to present itself. We may be able to take advantage of some shorter term buying opportunities in the market. But before we shift really strongly into capital accumulation mode, we'll definitely need to see improvement in some of those core indicators. Well, that's going to do it for today's update. Thanks for watching and have a great weekend.